Let's go back. Let's revisit that breaking news on existing home sales. Those numbers coming in stronger than had been expected. Existing home sales coming in a build of 5.25 million. Expectation had been for 5 million. We're joined now by John Brusuelas. He's director at Moody's Economy.com. Joe, you have heard the headlines there from Bernanke and existing homes. Your reaction?
Well, we got a very good pop this morning in the home sales. And that's what we expected, and we do anticipate that home sales will continue to firm throughout the remainder of the year. You know, we've gotten some relief on the moratorium for foreclosures, which did end in March. But these are good numbers. I'd like to tie this to what Mr. Bernanke said, though. We're going to get a nice little pop here in the second half of the year, having to do with some very aggressive fiscal stimulus programs, the unexpected success of the cash for clunker programs, and inventory restocking. But those challenges that Mr. Bernanke is referring to, you know, we can even see them here. When we look at distressed sales, you know, distressed sales actually have fallen from 50% to 30%, probably because of that moratorium on foreclosures. There's a certain lag, you know, before we're going to see another surge of foreclosures enter the home market. So we want to pay close attention to those distressed sales. We want to pay close attention to the inventories, because when we get into the first half of next year, the fiscal stimulus will be withdrawn, essentially, right? There'll be no more temporary boost from policy programs. So we're going to really see if private demand is ready to step up and replace public spending.
Joe, within those National Association of Realtors, numbers here, also seeing that the median price of a home fell 15% when purchases actually climbed greater than expected, as you know, by about 7.2%. We're still seeing prices decline here. So the build in sales, when we're still seeing price deflation, I mean, that's not a concern at this point for you?
Well, it's a longer-term concern. Right now, it's important that we clear the inventories. The inventories did not move, so that's not exactly good news. They held steady at 9.4 months to clear the inventories. We really need to see that fall back to 4 months. Well, one of the things that's supporting the housing market right now are low mortgage rates, increasing affordability, and falling prices, right? That's good. We need to clear the markets, but we're not going to be through this crisis until we reach a point where foreclosures peak and fall, and the declining prices actually stabilize. We think that may be sometime next year or the year after, but it's very difficult to tell at this point. So there are risks out there in front of us.
Well, the Fed chairman, Ben Bernanke, saying, yes, the global economy is starting to emerge from recession, but unemployment is really just going to happen. The decline is going to happen gradually. So what does that mean for you? You know, we see the light at the end of the tunnel, but it sounds like he's still saying it's going to be a hard slog till we get there.
Oh, of course it is. You know, we have the unemployment rate peaking at roughly around 10.1% in the second quarter of next year. You know, you're not going to see that unemployment rate stabilize, you know, until we see those initial claims fall to around 350,000 per year. And, you know, in Mr. Bernanke's speech today, I mean, we saw what we thought we would. He's making a very aggressive case that policy from the Fed is working. They're laying out, you know, when might they want to make that turn and begin withdrawing support from financial markets. They're very conscious of avoiding the mistakes the Federal Reserve made in 1936 and the Bank of Japan has made once at the end of the last decade and once earlier this decade. The Fed has to tread very carefully, but they also have to look at risks over the horizon, such as the unsustainable increase in public spending that the Congress and the administration are planning. So, you know, the Fed is proceeding carefully. They're laying out the fact that they have achieved some notable successes, but there are some challenges ahead.
Well, Bernanke also saying strains are still persisting in the global financial markets. You're seeing the market react very positively to the headlines that we just got. You're seeing, you know, more than 1% gain pretty much across the board there.
Sure.
When he says strains will still persist, does that indicate to you anything about an exit strategy here? Anything about quantitative easing and the future of that?
It tells me that it's going to take a number of months, if not years, emphasizing years, to gradually unwind the quantitative easing policies that the Fed's put in place. Let us be blunt here. We have an asset-backed securities market that before the crisis was $1 trillion. it's not functioning. We have a commercial-backed mortgage securities market that's $700 billion that's laying dormant. And we have well-known and well-documented problems ahead in the commercial real estate market. We see these banks failing. We understand that the FDIC is doing the best they can, but they're probably going to need more public money to support what they do. So there are very fundamental challenges ahead, and there are some still, real existing, very difficult strains in these financial markets.
And the Fed chairman seems to agree with you on that. We're starting to emerge, but it's going to be a long haul. Thanks so much, Joe Brusuelas of Moody's Economy.com.